Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss what 2020 gave the markets. Now 2021 is positioned to kick off the new trading year. Phil, it's great to see you. Welcome back to Trade Talks and Happy New Year. And it looks as if markets are all-time highs, rates are all-time lows, and that is continuing to help stocks. It certainly did in 2020.
Yeah, Jill, it looks like it is a happy new year. Stocks closed out last year at all-time highs. Interest rates are at all-time lows. Volatility has come back down, and we have a new round of stimulus approved. So things are generally starting the year pretty positively. And when you look back at last year, we've obviously seen a big change, a huge amount of volatility caused in March from the coronavirus. A lot of stimulus money coming into the system, a lot of fiscal support. That's why bond rates are so low. And a lot of nervousness even coming into the election as well. But a lot of those uncertainties seem to have been resolved, and we've got vaccines being rolled out as well. So a relatively positive news story to start 2021.
And Phil, that's driving some to say that we're in this new era of wild speculation driven by cheap money. Are you seeing a disconnect with valuations from earnings?
I mean, it really depends on how you look at the valuation of the market, actually. So if you look at earnings and the valuations of stocks, or the actual sort of price returns, there is definitely a disconnect. So the earnings have fallen recently, where the stock market has rallied. We've got a chart here today in orange and blue, and you can see the gap that's been increasing in the last few years as stocks rally, and it's not really supported by earnings. Obviously, the market's looking through the COVID drop. They're expecting with vaccines, a lot of the services companies that have been struggling for revenues because they've been mostly shut down or at least running at half speed, will come back, have extra revenues, and so we'll sort of hit a new normal, which is higher than before. But that doesn't completely support the gap that's opened up between earnings and valuations. What does support it a little bit better, though, is the fact that combined with all of that, we've got such low interest rates. And so when you look at valuations from a discounted cash flow perspective rather than a price earnings perspective, you actually do see that when interest rates go down, the discount factor goes down, the valuation multiple that you get goes up. And a lot of last year's increase was from that valuation multiple expanding. And when you look at the valuation multiples, so the price earnings ratios across different treasury yields, you actually see where we are today is pretty close to in line with normal. And it supports what we just talked about, where if the rates go up, the valuations of stocks will go down, the price earnings ratios will come down. But with rates theoretically low for longer and at such low levels, it does support roughly where we're at right now.
Are you concerned about the impact to future returns?
I mean, there's some interesting stats looking at what happens when interest rates are just as low as this, or when valuations are as high as this. And a couple of them do point to the fact that with rates so low, with the valuations and the PEs as high as they are, we should have pretty low expectations for the next 10 years of the returns for stocks. And that's sort of borne out over years and years. So doesn't say that we're going to have a negative next 10 years of returns, but it does mean we probably won't have such strong returns as we've had in other periods of the economy. So like through the 70s and 80s, where we actually had some pretty strong returns. And obviously in the sort of late noughties, we had some pretty strong equity market returns too. So the next 10 years might be a bit more challenging than them.
There's something else that's at all-time highs. Of course, that's the COVID-19 data that we're taking a look at this next couple of charts here. Just because the calendar has changed doesn't mean that COVID-19 is going to magically disappear.
No, in fact, people are talking about the fact that everybody's Christmas and New Year's celebrations might be creating a new spike. And there's a little evidence of that already coming through the US data, which is the black and orange chart. Having said that, the global data, it's stopped increasing at the rate that it was when we were sort of talking through October, November. And obviously we've got vaccines rolling out now. Israel has reportedly vaccinated almost half its population. So if that continues at that rate, we might start to see whether the vaccine really is as good as we expect it to be. And they might start to see a market improvement in their contraction rate and an infection rate. That's going to be great news for the rest of the world. We're a bit slower at getting the vaccinations out, but if the vaccinations really do work, then we should start to see that increase in cases come down as well, which would be good news for the economy. And most importantly, it's going to be good news for a lot of the people that are stuck in the services sector, because although retail spending is above pre-COVID levels, it's a lot of online spending. And although a lot of the manufacturing indexes are still above pre-COVID levels, a lot of the services industries are still suffering and well below pre-COVID levels. And that's a big employer for a lot of people. So that's why we keep hearing that the impact on households is really dispersed, and there's a lot of people that are hurting a lot more than average. So with the vaccine coming out, hopefully it can be distributed pretty quickly, and all those people working at events or in travel and hotel industries and airline industries, even at bricks and mortar retail stores, can start to see more foot traffic and actually boost their revenues and increase their employment too.
And Phil, to wrap up here, let's talk U.S. politics with 16 days to go into the inauguration. Would you say that the election risk is for the most part resolved?
1 day to go until the Georgia election too, which might be even more important, because if the Democrats can win both those seats in the Georgia Senate runoff, they will theoretically have control of all three branches of government. That would make it much easier for Biden to implement his policies. As it stands now, the expectation is the Republicans will win one or both of the Georgian seats, and that means that we'll have sort of a bottlenecked or blocked parliament for Biden to get any policies done. But in terms of the risk of Wednesday's ratification of the votes, I think the market is generally expecting that to be a non-event, even if some people do protest the actual counting. And I think we're expecting in 16 days to have a new president. And the question really is how quickly and how aggressively can the policies change because of that?
Well, I'm sure there'll be no shortage of news flow in 2021. That's for sure, Phil. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.